Good morning, good afternoon, good evening, depending where you are on the planet. And welcome to the Monday, the 25th of July, Bull versus Bear webinar. Steve Miley on the call for trade day. Welcome, everyone. We're going to go through our kind of usual regular run through in here today. Slight difference on a Monday. Take a look at, the bigger picture look of the week, the shape of the week, as I like to call it. I think it's important, as I always say on a Monday, to, even if you're a day trader, which a lot of you guys are, obviously on a day trading program here at Trade Day, it's a good idea to have an understanding of what's going on in the bigger picture, what's going on coming up in the week. Something I've been doing since I've been in markets for over 30 years now, to have a real understanding, because even if you're a day trading, or even if you're intraday trading, scalping, very, very close proximity on your time frames, then I think it's still important to have a feeling of what's coming up in the week, because volatility can change and can alter depending on if you've got bigger events coming out later in the week, etc., etc. So I think it's important to do that. So we'll have a look at the shape of the week, what we've had, what we've got coming up on the weekly basis on the macroeconomic fundamental data front, and also on the earnings front. So we'll take a look through that. And this is I publish this every week. You'll get this on the, if you go to the I can't go to the members area. If I go to the trading room in the members area, then that's obviously where the this video plays. So we'll get a load of feedback. So I won't be going to that area right here, right now. But if you go to the members area, to the trading room in the members area, then you'll find where the technical analysis reports are uploaded, the daily technical analysis reports from me, the market charts reports. You'll also see this uploaded, which is I usually put it up on a Saturday or Sunday. Usually goes up on a Sunday, and gives you a recap of the previous week and an outlook into this week. And say hi if you're on the good morning. Clinton's just saying hi in the chat. There is a chat box below that streaming live webinar. The live webinar streams in the trading room. I can see there's a few of you guys on this morning, so morning to you. If you do have any questions, by the way, please do fire them into that chat box below the where the webinar streams, or email them ahead of time, right? If you want to do that, email into either Steve at Trade Day or support at Trade Day. Steve at Trade Day is good, and I can run through anything you might want to run through. So if you want to go into some more specifics, but let's go through this anyway. So what was interesting last week? We had something I did note last week, but I think it was something important to recap on. So I worked at Bank of America. It was only Bank of America for a very short time when I walked there. Merrill Lynch, Bank of America. This is the Merrill Lynch. It was the Merrill Lynch Fund Manager Survey, which is highly respected. It's been going decades now. I mean, I can't remember when it was launched, but it was launched, I think, when I was there. But so we're going back into the 90s, I think, that this was launched. Actually, let's have a look at it. The ML Fund Manager Survey, just for my own peace of mind. History. Let's see if I can find out just while we're here. Oh no, it's not gonna. No, it's not going to tell us. Oh, this is one from 2013. I don't know. It's been going for decades anyhow. But in that fund manager survey, so interestingly, it showed that the funds, it's a survey of fund managers, funds cash holdings at their highest level since 9/11, right? So that's, over 20 years. So the level of cash, percentage level of cash holdings by funds on the fund manager survey, the highest level on the survey since 9/11. Equity exposure, so their exposure to stocks, lowest level since the global financial crisis, 2007, 2009. So I think this should be used seen as a contrary indicator. What it means is there's loads of cash on the sidelines waiting to go to work, right? The funds are massively underweight stocks. So if we get signs that the market is bottoming, and I've been saying that the market's been bottoming since June, we've been in a choppy sideways range on the major equity indices. But last week we took out some important highs from May, June. and pushing through those highs have created better basing structures. I think there's a good 5 to 10% up from here going through the summer on the broader indices, maybe towards 10+% for the Nasdaq. So that's my view. If the markets start to do that, there's a lot of money to be put to work. These fund managers maybe become false buyers. A lot of that cash that's sitting on the sidelines may come back into play. So we need to watch out for that. So, that's something, just as a little recap to note. Earnings, the standout last week was Netflix. We already discussed this, but they lost fewer subscribers than anticipated. They anticipated Q2 2 million, I think it was around 2 million, only lost around 1 million. So that was positive. The stock was up about 15 plus % last week after that news. And they predicted that subscribers that there would be and predicting that they would have subscriber and adding in subscribers later this year. A couple of technical things. One technical thing: European Central Bank, the ECB, raised rates. That was anticipated. They also put into place this transmission protection instrument, which is another bond buying instrument in here to make sure that the spreads on the peripheral of Europe. So we're talking really Italy is the main, can be the main casualty because it's kind of part of the core, but part of the peripheral as well. And if Italy gets under funding pressures, which they can do, if you see the spread between Italy and German bonds widen out, so that's Italian government bonds pushing significantly higher in yield. Okay, that's obviously a problem for the Italian government. Okay, and they've got a lot of problems at the moment with a breakdown in their the current government as it's broken down, and some real problems going back to new elections going forward. So so that's kind of to protect against that. And then we also had UK CPI data last week running really hot. What was the tail of the tape on the actual markets? Well, we had, as I said in here, US equity indices pushing above important resistance levels, reinforcing bases that have been put in place since June. European and Asian stock indices making similar statements. US yields pushing lower, now down close to the comfortable below 3% level. If I scroll down and look at the chart and the US yield chart in here, you see in here we're getting really close to this yield low that was from May. It breaks through that yield low from May. That's a bigger topping pattern in here for yields. That puts downside pressures on yields. Lower yields, remember, are particularly good for growth stocks, so particularly good for the Nasdaq. Okay, so we'll certainly see that going on at the moment. The dollar has pushed lower. The dollar signaled a topping pattern. We've been talking about the dollar slowly turning. Stocks have been forming this base. The dollar kept pushing higher and higher and higher through June, through into July. However, we have seen the dollar index and the euro versus the dollar turn. So look, we had this kind of 2 weeks ago, we had this kind of slight failure pattern, this candlestick pattern on the dollar, and last week down for the dollar. So dollar looking like it's more like a topping pattern, and the euro having broken down versus the dollar below parity has now rebounded, signaling a base. So if the euro can rebound from some extreme multi-decade weakness, maybe some of the other currencies too is happening. So the Australian dollar, New Zealand dollar lead market higher actually, particularly the Australian dollar looking really strong. And that's because we're going into risk on phase, right? Risk on. Traders willing to take more risk. That's why stocks are rallying. And that's what we're seeing with the bonds in here as well to some extent. So, and the turn in the dollar as well. So that's what we've had there. What have we got coming up for this week? And oil stays choppy. Just a quick nod to oil and gold. Actually, gold started to put in a base. Now, we've said there's been a dislocation. The dollar started to turn, but gold hadn't really started to turn. But if we look down here now, you'll see that gold has started to, it had a significant sell-off and a rebound, a hammer-type candlestick on the weekly chart for gold. So that's signal a potential base. So they're playing gold maybe from the long side. Oil still looks negative, and copper still looks negative in here at the moment, although copper also trying to base. Let's go back to seeing what we've got coming up for the week. So now looking at the shape of the week. So the critical event of the week is going to be the Fed on Wednesday. There's loads of articles. I'll just run through them really quickly as we go through the session today. Loads of articles in here being published by Reuters, by Bloomberg, by all the major news wires about the Fed, but pretty much nailed on for a 75 basis point hike. the statement and the press conference are probably going to be more important to see how worried the Fed are. Are they going to become even more hawkish? That the curve at the moment is telling us, the interest rate curve is telling us not. We'll look at the Fed tool shortly. On the data front, we also get German IFO survey this week and CPI data. The most important data from the US is going to be consumer confidence on Wednesday, and then we get durable goods on Thursday. I actually got this. Oh, okay, that shouldn't be there. Oops, that's incorrect. That there, guys. It starts in here. Sorry. Consumer confidence is Tuesday. My mistake. That's not there. Okay, that should be taken out. US durable goods on Wednesday, and then the Fed as well. Obviously, we get then probably the most important data of the week. Not the GDP data. Remember, GDP very lagging as data goes. Not going to probably move the market. The PCE data is more important. We get both year-on-year, month-on-month, and quarter-on-quarter data spread across Thursday, Friday. The PCE data, personal consumption expenditure, the Fed tells us it's their preferred measure of inflation, so we should certainly be watching it. Yes, the CPI data still moves the market more, but the PCE data is what the Fed watch, so we should be watching it too. Okay, so we're watching those over Thursday and Friday. So Fed on Wednesday, that data probably most important Thursday, Friday. Also consumer confidence, durable goods Tuesday, Wednesday. On the earnings front, it's a really big week for earnings. Okay, that can knock on into obviously the major indices, particularly the Nasdaq, because we've got the big tech reporting this week. So we have Microsoft, Alphabet, which is Google, Meta, which is Facebook. Boeing has a big impact on the Dow. Okay, so remember, because the Dow is a price weighted index. Yeah, Nasdaq and the S&P are capitalization weighted. The Dow is price weighted. So Boeing has a bigger impact on the Dow. We also get Apple, Amazon. So of the big tech, most of the big tech, we had Netflix obviously last week and Tesla, but Microsoft, Google, Facebook/Meta, Apple and Amazon all reporting this week. We also get ExxonMobil and Procter & Gamble also reporting this week. Let's now dip in, so just going to the calendar here where they are. So this is the weekly calendar. So nothing really of note, nothing really significant in here this week. These are all much smaller companies in here. Sorry, not this week, today. Going into tomorrow, though, Microsoft and Google tomorrow. These are all after the bell. Microsoft, Google. We also get Visa and Coca-Cola tomorrow, McDonald's as well. If we go down, Meta, which is Facebook, we get that on Wednesday, again after the bell, after the close. Also Qualcomm, T-Mobile, and Boeing is in there as well. Boeing is in there on Wednesday. And then scrolling down, Thursday, Apple and Amazon. We also get MasterCard, Pfizer, and Merck & Co. on Thursday. And then Friday calms down a little bit. We still get ExxonMobil, Procter & Gamble, Chevron as well. All going to be significant. But the biggies are obviously that big tech. So we're watching for the big tech as we go through the week. And as we said, that all those big tech report after the bell, after the market is closed. Okay. So after the cash markets closed, nothing really of note in here. We've had the German IFO survey, which is a business climate survey, missing on expectations, obviously disappointing. Let's run through some articles from the Nature Newswise. There's not a huge amount in here that we don't know. Although there's a lot of articles I've got here, as we go through, you'll see that it's not particularly anything, no real big kind of revelations in here. Futures rise up this morning. So we've had a little bit of a dip earlier on today when, I started the day today. We were actually slightly lower. Market has rebounded since then. So futures slightly up in here this morning. 5 things to start your day. Fed week. Okay, we know that. 75 basis point nailed on. Let's go take a look at the Fed tool. So you can see in here for this week's meeting, nearly 80% chance of a 75 basis point hike, with only an outside chance, less than 25%, just over 20% chance of it going for a full 1 percentage point. If we go to the going out to September now, real kind of mixed in here. So given that we're expecting a 75 in here, which will take us up to the 225 to 250. If we go in here, we'll see now this is only for a 50 basis point hike, right? So this in here is totaling, this is totaling 125 here, right? So 50% chance, that we'll get 75 and then 50. Okay, this is a total of 125. Here is for 75 and 75. So the biggest chance is now the next rate hike in September is only going to be 50 basis points hike, but only just, right? And then but if you add these two together, these are obviously over 50%. So this is actually saying, well, the risk of there being either another 75, which would be this one here, or actually a 75 and 100, or 100 then a 75, is actually, there's more chance of that than there just being a 50. We're going to get probably a lot more guidance, a lot more understanding from the Fed when we hear from them this Wednesday, okay, as to the subsequent rate hike. Let's go back to them 5 things to start. So the Fed is one thing. Investors are skeptical that the Fed can tame worse inflation. There's a report here where Morgan Stanley and JP Morgan disagree on outlook for Fed's pivot. Morgan Stanley strategy says it's too early to expect the Fed to stop tightening its policy. Okay, whereas JP Morgan and here strategists say bets that inflation has peaked will lead to a Fed pivot and improve the picture for equities in the second half of this year. Okay, so a different scenario coming. So even like these, two major investment banks got very differing views on what's upcoming from the Fed as we go into the second half of this year. Okay. Pandemic has put unprecedented strain on global supply chains, workers striking. Okay, we're seeing this in the UK, we're seeing it now in the US. 2.5 members of a union represent 3 Boeing defense locations are voted to. Okay, so we're getting disquiet in the labor market in here. Not surprising given where inflation is running. Okay. Stocks are looking up in here this morning, okay, and a quiet data on the GDP. Sorry, a quiet on the data front today. There's that Morgan Stanley article. So again, a load of articles on the Fed in here. Fed to inflict more pain on core as it read its big rate hike. Okay, recession seen is increasingly likely. So, it's going to be really interesting to see what we get. German on brink of recession. That's the IFO data we've already spoken about in here today. And more articles on the same about the Fed. Fed's united front on interest rates may soon be tested. In here, US interest rates peak seen in 6 months. That's what the futures market is telling us, right? So, again, in here, if we go out here, where's the peak coming? Well, if I go out to February, 325, 350, December, 325, 350. They've got the peak there. Look, December 325, 350. Where's the peak in rates? We're expecting in February 325, 350. Expecting near 325, 350 still going out into March. And then come as we get out into May, still just 325, 350. And by June, okay, rates now 300, 325. So somewhere in there, the expectation is rate cuts coming May to June and peaking rates coming in here. If we look for November, 325, 350. So even as early as November, rates may have peaked, okay? If we have this to believe, they could have even peaked by September, but more likely peaking rates coming November/December in here at 325, 350 is the expectation. Now, within the market, what else we have in here for you? German on the cusp of recession, says IFO. We've already spoken about that. So the same old articles. Weak German data, earnings weigh on European stocks. So European stocks have dipped a little bit in here. Dollar in here this morning has slipped lower. Risk currencies doing well. Already spoken about that. Australian markets. The Australian dollar continue to do well in here over the last week or so. The Australian dollar is up about 0.75% today. And we have the New Zealand dollar in here this morning up. Where are we? New Zealand dollar, 0.8, okay, 0.8% in here. Even the Canadian dollar, US dollar down, Canadian dollar up about 0.33%. Okay, the pound even managing to bounce. So dollar down across the board. Risk currencies, Australian dollar and New Zealand dollar leading the way higher as we're in this risk on mode. This is reinforcing the positive outlook we're seeing in the stocks market at the moment. And if we take a look at European bourses this morning, slightly up. Between about 0.25% to 0.5%. The CAC, that's the French index, 0.5%. The DAX, the German index, 0.4%. The FTSE 100 pretty much unchanged, just slightly higher in the UK this morning. And if we look at what US is doing this morning, we're up about 0.5%. These were down this morning. Yeah, when I first woke up this morning and on the overnight, we were down a couple of tenths. So we've managed to rebound between about 0.5% as we've gone through the overnight session so far this morning. Right, a very, and it will be very quick look at the charts in here, guys, just given time. So it was a strong move up higher last week. This is starting off with the S&P 500, really strong higher, taking out those peaks in there from the end of June. That was important. Also taking out the trend lines in here. Look, we're flirting with this trend line though. So the market really needs a more emphatic push through there. And we did have a strong session Friday initially and then set back. But you can see already rebounding, getting back of some of the dip that we saw on Friday on the S&P. If I go to the 15-minute chart in here, just zooming in, this is, you can see in here. So there's the, I'm just going to get rid of all this old analysis. Where's that gone? Oh, there we go. So in here, so you can see in here, there was the dip back lower that we saw on Friday. There's Friday's dip back lower. And then this morning, as we opened up in here today, the market did initially dip slightly lower again, but then a really strong recovery in here. And got back a lot of Friday's losses in here already today, okay? So that's seen as a positive. You know, for me, this could only play this from the long side going into today. And similar story for the NASDAQ. So we had that setback, you know, a strong session initially on the NASDAQ and then setting back, but look, getting back some of the losses there already in here this morning. Again, overcoming these important peaks in here and really targeting this peak up here. I wouldn't be surprised for us to attack that high going into the maybe even pre-Fed. It might not want to have a go at that ahead of the Fed, but you know, I wouldn't be surprised if we get a go towards that. That's just below 13,000, 12,973.75 up there. Going back into the 15-minute chart in here now. Going to get rid of all the old analysis, but there's Friday's sell-off, you know, Friday's initial strength and then sell-off, okay? And then the market, you know, did dip lower this morning, but then look, a decent rebound. Again, for me, this is pointing high. If I just put the fib on this, Fibonacci tracement of just Friday's sell-off, that's just Friday's sell-off in there. And you can see the market it's above the 38.2 and holding above the 38.2. Next target, the 50%. And so there's pretty much no kind of real resistance of any kind of note. We did plummet quite aggressively at one point on Friday. So there's actually very little in here from chart resistance, okay, that we've got. So yeah, for me, all the risk in here remains to the upside. Very quick nod to the commodity markets, gold and oil. Here's oil on the September contract. Yes, a dip and a rebound, but we had this morning, but nevertheless, the weakness from last week. I don't think we're going to hold on to it. I think this is now a sell opportunity on oil. So the market did go initially lower in here this morning. September contract has rebounded. So you've got a hammer pattern at the moment, okay? But if I step in now, onto 15-minute chart on oil. For me, I'm going to get rid of all of this again, all the old analysis. In here, I think this is a sell opportunity. You see the market has had this rebound, did take out this high here, but now kind of sideways in it for the last couple of hours. And if we look at the trend line off the top, this trend line through here, extend it out. Okay, look, the market clearly hesitant to take out this trend. So whilst below this trend line, which comes in around 96.25 kind of area, whilst below there, I think we stay bearish on here for oil. Okay, so this is just on a 15-minute chart. This is just the latest sell-off in here we've seen over the second half of last week. Okay, so that's just this sell-off in here, just this move in here. Okay, that we're looking at here on the 15-minute chart. But, you know, clearly the market reluctant to take out this trend line. And you could actually argue, do you draw the trend line? You know, maybe a better trend line is through here. Probably not through there, actually. Maybe through there. And you can see it's flirting with the trend line, that one through there. So you draw it through here, and then it kind of flirted with it here, and it's flirting with it again in here. So somewhere between this resistance, between like 96.10, 96.30 kind of area. If we stay capped below there, I'd prefer to play this from the short side on oil. If we take out 96.30, then it's probably pushing back up towards like the 98 area. okay, on oil. Not to gold. Gold is trying to turn. Here's the daily chart in here on gold. So we've got that solid rebound in here back on Thursday, pushed higher again Friday. I think that's a turning point. Bullish outside pattern back last Thursday to signal the turning point. Inside pattern so far today. Stepping in, I'm going to go actually to a 15-minute chart on here. So there's a solid rebound, dip and a rebound in here, looking positive. I still think looking positive in here. You've got this little kind of coiling pattern there, though. But whilst it's above, you've got arguably this support here, and then also this support through here. And whilst above these, that's a great trend line there. Look, whilst we're just holding, that's at 1726. Whilst holding 1726, that trend line there, I think you play this from the long side for me on the gold. And just looking at the daily chart, it looks robust. It looks like we've got a little bit of a base again in here on this more accelerated kind of little downtrend through here. This latest down move, that's a bad trend line. Hold on, let me just clicked on the wrong point. We kind of reversed this little downtrend in here, the latest down move that came from the early part of July after you had the impulsive move lower at the beginning of July. The more gradual move, we've reversed that. So yeah, I'm playing that from the long side in here for gold, for me anyway, for now. Okay, I'm going to wrap it up there, everyone. Thank you for joining the Bull versus Bear webinar this morning. A little bit fast-tracked through there on the charts, but obviously on Monday we'd spend a lot more time looking at the macro setup, the bigger setup, and doing the recap of last week. I'll be back with you with another webinar tomorrow. If you do have any questions, you want anything to if you want me to cover anything in the webinars in particular, please do email through steve@tradeday.com, and I'll be back with you with another Bull versus Bear webinar tomorrow. Have a great trading day. Bye.